Hello there, everyone, and welcome to the latest episode of our Market Misbehavior podcast. It's been such a pleasure to share some conversations with you through the course of our podcast. We're right around 30 episodes of this podcast that we launched toward the end of last year, and I appreciate so much your suggestions of who we should sit down with and encouraging words as we continue to try to capture some good discussions with top market practitioners, investors, strategists, authors, educators, anyone else we can grab to talk about market conditions. I want to share with you a recent conversation I had with Kristina Hooper. Kristina is well known in the financial industry. She's the Chief Global Market Strategist at Invesco. And just a really thoughtful, knowledgeable market strategist. We kind of went full macro with this discussion. This was at the Las Vegas Money Show just a couple weeks ago. We talked about a number of topics, separating the noise from the signal. And I thought just starting the conversation there sort of set the table for a fantastic discussion. I mean, given the frequency of news headlines and sudden market shifts here in the early days of 2025, I thought her comments on, just relating noise and trying to separate noisy, day-to-day market movements from the signal, from things that are actually meaningful, were really helpful. We obviously talked about a market outlook, and to be clear, we recorded the conversation, sort of mid-February. So I feel like the world has changed in so many ways, but in a lot of ways, it hasn't changed at all. And so I think getting a sense of what Kristina was seeing at this particular point, thinking about what has changed just in the couple weeks since, could be a really good exercise for all of us. We talked about the potential impact of tariffs, how that relates to other macro conditions, talked about the changing trend in the US dollar, how non-US markets have really started to outperform, which is a trend that's certainly continued. We talked about inflation, we talked about the Fed, and I thought her comments on evaluating the Fed's activities year to date, and really going back into mid 2024 and this rate cut cycle, the potential for rate hikes in 2025, I thought were all really interesting perspectives that you're going to want to hear. We talked about risk management, evaluating risk in the current market environment, what risk management should mean for individual investors. And I think toward the end, her comments there were really important. In my experience, and certainly in Kristina's working with institutional investors, you tend to have a great focus on risk, because that's a big part of your perspective, is managing potential rewards versus potential risk. But I found with individual investors, they're a little less attuned to potential risks. And now is the time, I would argue, in early 2025, when you definitely want to be thinking about potential risks and how to get ahead of those as much as possible. Talked about gold and the strength in the commodity space. Talked about valuations and what they mean here in the first quarter of 2025. Just a far wide-ranging discussion covering a lot of great topics, but I think really demonstrated Kristina's understanding of market conditions, and I thought her way of cutting through all that noise and focusing on the most actionable ideas was really, really well put. So please enjoy this recent conversation with Kristina Hooper of Invesco. So we're here at the Las Vegas Money Show. Super excited to be sitting down with Kristina Hooper. Kristina is the Chief Global Market Strategist at Invesco. Kristina, I've heard so many wonderful things about you, and it's such a pleasure to make the connection and chat with you today. Thanks for coming on.
It is so great to be with you today, so thank you so much for having me.
And you just traveled in from the East Coast, so you look remarkably put together and in the right place. So I'm hoping for 20 minutes we'll be fine, and then you'll be released to recover.
That's all I can say.
We'll be good. I noticed as I was prepping for our discussion, you posted on social media not too long ago, the markets dealt with an exhausting influx of news last week. And I feel like that phrase could be used to describe the markets in a lot of days recently. How do you sort of navigate through the noise that I feel like we're overwhelmed with right now and get past the noise and focus on the signal, on what's really important to you in your process?
Well, I think what I've learned from the last months and years is really that markets have an incredible amount of intestinal fortitude, usually.
Right.
And so there will be a point when outside noise or events will cause market jitters.
Yes.
But until then, markets will just keep humming along, and we just have to recognize that happens. I mean, it's very similar in terms of the tolerance for high valuations. Markets can be very tolerant of high valuations until the day that they're not. And then we go through a period where they're not tolerant. But for most investors, they have a long enough time horizon that
Yes.
that can be pretty irrelevant.
That's fair.
So we just have to put on blinders and ask ourselves, well, what's important? I mean, certainly if you're a tactical investor, a lot of this does become important. But for your typical investor with a long-term time horizon, a lot of this is irrelevant. But to answer your question more specifically, I think what you need to do is follow the signs. In other words, look at market indicators that there is concern or there is risks are growing or the perception of risks are growing. And so I'll just call out one example, inflation break-evens. So looking at that spread between 5-year treasuries and 5-year tips, for example, we've seen that climb quite significantly from September to now. That suggests that investors think inflation risks are increasing. So that's good to process. It's an area where we're seeing that what's happening is impacting perceptions. And so we just have to recognize that the probability of a resurgence in inflation has increased. It doesn't mean it's the base case, but it has increased, and be cognizant of that.
So, I mean, tell us, just evaluating market conditions here in February 2025, we're coming off of a remarkably strong year of 24, major averages having one of their best years in recent memory. Now, all of a sudden, early 2025, things are starting to feel different, I feel like, for a lot of investors, right? Things that have been doing really well are doing kind of well, even though there's the metas and others kind of still doing fine. When you're assessing the market conditions, do you see more reasons to be confident about further upside for the major equity averages, or is it more a measured, this is a change of character type of environment?
So I think we have to recognize that no matter what's happening, 2024 was a really strong year. So it would not be unusual for markets to take a breather, to have some level of consolidation. And I think that to a certain extent, that's what we're seeing, is that other major indices, Chinese stocks, European stocks, UK stocks, are doing better than US stocks this year. And that could last for a significant period of time. It doesn't mean that US stocks are going to fall, but we're digesting what were very significant gains. And we're also processing all this new information that's coming in and trying to make sense of the policy agenda and also the execution of that agenda and what it means for stocks in the US.
This is one of those times where I feel like every day is a flurry of headlines, in many ways very unpredictable in terms of what's going to come next, particularly from the new administration. And not to get political, but how do you think about the headlines, particularly around tariffs? Do you see the idea of tariffs and what we've learned so far? Are these things to be concerned about? Are these more negotiating tools that are going to be a non-factor for stocks? I feel like the markets have held up pretty well despite some of the headlines. How do you make a sense of tariffs here in February 25?
Well, when we looked at the different candidates' policies last year in terms of sort of trying to provide some kind of guidebook for investors, all we could do was look to the first Trump administration when it came to tariffs and say, what happened there? And, it's not a bad story, right? We had sort of a short-term impact. Tariffs, if we were to go back and look at the Federal Reserve Beige Book, what we heard anecdotally was prices increased. We saw that there was a temporary level of uncertainty that caused hiring plans to be on hold for some businesses, that caused some businesses to delay investment. But all that was pretty short-term in nature. We also saw the stock market fall, but that was also short-term. And then once tariff wars were, for the most part, over, that then stocks resumed their climb and things went back to normal. So I think that is the best kind of sort of guideposts we have for what is likely to happen this time. Now, to your question about is this a negotiation tool, I would like to think that it is, and that to a certain extent, the Trump administration is taking a page from the Reagan administration playbook. Now, Ronald Reagan was a big believer in free markets, as we know. He was not a fan of tariffs. But he did something similar in terms of going against free trade tenets, in terms of getting Germany and Japan to sign on to voluntary import controls, or for them export controls, which is kind of an oxymoron. But they agreed to it, and as a result, what you saw was the building of a number of different auto factories in the U.S. that exist and employ Americans to this day. So it was a policy achievement that was quite significant, and I think that is probably what they're aiming for. So I think that's why markets are willing to tolerate it, and I'm comfortable with that. Other policies I'm not as comfortable with, but I'm comfortable with that, and I think any kind of negative impact would be short term.
You mentioned some of the non-U.S. markets doing quite well here early days of 2025, and 2024 was certainly U.S. over non-U.S. was kind of the play. Stronger dollar, a big story there. All of that has now started to change. How should, I feel like a lot of individual investors probably very underweight, if not completely out of non-U.S. markets for understandable reasons. How should they be thinking about their non-U.S. exposure here? Is it a diversification question? Is it a play on the dollar? How would you suggest people think about U.S. versus non-U.S. weightings in their portfolio's?
Well, I always try to orient investors to think long term. I think that makes sense. That's the time horizon for most investors. And so that means this is a diversification story. And I think it's important for investors to recognize that economies don't have to be firing on all cylinders for their markets to perform well. I think there's this myth that, hey, we're going to stick with the U.S. because the economy has been so much better than other countries that's where the market is going to outperform. The reality is that quite often the best performance comes from markets where there's just a little positive surprise. There could be an awful lot of negative sentiment. I mean, look at the European economy. It is not the U.S. economy, and it hasn't been. But there's some positive surprise there, and we've seen European equities do quite well. And I think there are a lot of examples of that. So I would say first and foremost, it's about diversification, reversion to the mean, lower correlations. But I do think that right now the timing is appropriate to say, do I have enough exposure? Because, hey, there are a number of markets where we're seeing some positive surprise and we should be participating.
No, it's well said, Kristina. Let's pivot a bit and talk about the Fed. Obviously, Fed rate cut cycle has now become a sort of Fed pause cycle, and now that's sort of the big debate is how many cuts do we get? Are rate hikes in the in the cards potentially? If you're I guess supervising the Fed, how would you evaluate their actions over the last 12 to 18 months? Do you think they've been ahead of things appropriately? Would you say that there are things they could have done differently? How would you assess the performance of the Fed, or I guess the actions of the Fed to date?
Well, I think it's interesting that you gave me a 12 to 18 month timeline.
That was on purpose,
right? Yes. Because I think if you said 5 years, I would say they made a huge mistake. They were too late starting to hike. But having said that, I think the last 12 to 18 months we've seen pretty appropriate actions on the part of the Fed. I think the pause made sense. I think rate cuts made sense. I might quibble a little with timing, speed, but at the end of the day, I think it's been appropriate to be data dependent. That's all they can do. And recognize that they don't know the impact of policy, and so they shouldn't be front-running the policy effects. They should wait to see what is happening. And I think they're doing that. Now, I'm in the camp that still believes that by the end of the second quarter, the Fed will cut, or is likely to cut. I think my base case is we will get a few cuts this year from the Fed. But having said that, I do think the risk of a resurgence in inflation has grown. And so there's always that possibility the Fed could hike. That's okay. That's what being data dependent is all about, and not being on a preset course. So I'm very comfortable with where the Fed is today. It's doing the best it can. It's a tough job.
It's not a job I would wish on anyone, to be honest with you. The mandates they have to abide by are pretty tough. Tell me about this. The 2% inflation target has been something that's been talked about for quite some time. We've gotten closer to that, but it's still not where we're at. Do you think that 2% annual inflation target is a reachable goal, or is that more of an aspirational, we're ready to cut when we need type of goal? I mean, what do you think?
So I think it's aspirational as we sit here in February of 2025. But that doesn't mean that it's not aspirational, that it's not realistic or very close to reality. Late in 2025. We'll see where the data takes us.
Sure.
I think we also have to take a step back and recognize that there needs to be some flexibility around the target, and the Fed allowed for flexibility on the other side. Recall, we were tolerating inflation at 1.7, 1.8%. No one worried. So is it so bad if we were to have 2.3% inflation, 2.35% inflation? So hopefully the Fed is flexible on both sides of that 2% target.
It's interesting. I feel like 6 to 12 months ago, if you'd suggested there might be Fed rate hikes, you'd probably be laughed out of the conversation. Now it feels maybe a little less so, like it's possible. Do you think rate hikes are possible? And if so, what do you think they would need to see to, need to take that kind of action?
So I think at least a Fed rate hike is possible this year. And so what would the trigger be? Well, I hearken back to June of 2022. The FOMC meeting in June, we saw a 75 basis point hike in the Fed funds rate after the Fed had really messaged it would only hike 50 basis points. And so at the press conference,
big surprise.
Exactly. And at the press conference, Jay Powell was asked, what happened? We thought you were communicating 50 and then you do 75 a few days later. And he said, we got a few data points between then and now that changed our mind, and he included in their CPI and Michigan inflation expectations. So I think we need to be focused on the same indicators that the Fed is focused on that has changed its mind in the past. And so inflation expectations matter. I think it's important to note Michigan inflation expectations have had a huge jump in the last 2 months. And not so much in the New York Fed inflation expectations, not so much in Conference Board, although there has been a jump. But the biggest was Michigan, and don't think that has gone unnoticed. So it's more of that. If we were to see core CPI, core PCE, back up, I think that's obviously the most important, their preferred gauge. But even core CPI will matter. All those things form a mosaic, and if the picture looks like inflation is getting hotter, I wouldn't be surprised if the Fed changes its language. I don't think they want to hike, but ultimately might be forced to hike.
They have done some subtle and not so subtle changing of the language recently.
They have. And I think also the ghost of Paul Volcker looms large over the Fed. No one wants to be the next Arthur Burns. They don't care. They don't seem to care as much if they're the next Herbert Hoover. But no one wants to be another Arthur Burns.
So when you think about potential risk to this market, obviously, the major equity average is still very close to not, if not at near all-time highs. What are the risks that stand out to you as an investor here in February 2025? Is it a resurgence of inflation? Is it a change in Fed policy direction? A risk we haven't talked about? Like, what stands out to you as the biggest issues we may have to deal with here?
Well, you named two that I think are connected, right? That resurgence in inflation that causes. Because I think a modest resurgence in inflation that doesn't really impact what the Fed does. But if you have a resurgence in inflation that causes the Fed to change, to alter its course, I do think that can be quite impactful. I also think, of course, markets have shown every now and then that they worry about high valuations. So if we were to see the 10-year go up, and that would be independent of what's happening with the Fed funds rate, but if the 10-year yield were to go up to get to that psychologically disturbing 5% level, that could be problematic, especially for high valuation names. Again, all of this just makes such a strong case for diversification, both across and within major asset classes. So we've got to be in equities and international equities. We've got to be in a broad spectrum of fixed income. And we've got to have some alternatives in our portfolio. That to me is this is the kind of environment that really underscores the need for diversification.
You mentioned, sort of being in other asset classes. Have to think about commodities, particularly gold, which, even with the incredible rally we've had in equity averages, gold outpacing the S&P and the Nasdaq last year, this year, year to date, gold outperforming. Where does gold fit into the picture for you, and how do you evaluate the need to diversify in hard assets that have performed quite well here?
Interestingly, gold has historically had a lower correlation with stocks.
Yes.
And in fact, we've seen, in times when stocks have gone up, gold has gone down and vice versa.
Yeah.
But the two have exhibited a much higher correlation as of late.
Yeah.
And, in sort of trying to understand what's happening, one of, I would say my thesis is that we have a lot of investors who want to be risk on, that want to participate in the stock market.
Yeah.
But at least a part of them is worried about geopolitical risks, is worried about growing fiscal deficits, all those things.
Yeah.
And so the expression of that is to have an allocation to gold while still maintaining an allocation to equities.
Yeah.
And again, I think that makes sense. That's part of being well diversified. I think there are just a number of reasons for investors to have some exposure to gold in this environment.
Yeah. Given the trend that we've seen, you mentioned valuations. I mean, arguably, it's hard to describe the markets as not at least overvalued or richly valued by a lot of measures, particularly some of the leadership names in the growth space that have done so well. There are times in market history where valuations don't seem to matter a ton. Then there are times when all of a sudden they really matter. Is 2025 one of those times where we'll shrug off high valuations and follow trends, or do valuations become an issue? And what does it take for people to kind of wake up and recognize that, in your opinion?
I think it depends.
Yeah.
I think it depends where we see the 10-year Treasury yield go.
Yeah. Yeah.
I think it depends on Fed policy this year. But probably the most likely scenario is that we have phases in the year where valuations are a source of concern.
Yeah.
But for the most part, I suspect that we're going to have an environment this year where stocks U.S. stocks post, solid returns, nothing shoot out the lights.
Yeah.
There's probably going to be some volatility along the way, but we'll end up higher than where we started, and along the way there will have been a few protests about high valuations, but markets don't protest too much.
And the markets don't often care what we think, do they, right? In terms of valuations necessarily.
Exactly.
How do you think about leadership and leadership rotation, right? Because we've had a period in the market where it's been dominated by AI, by very particular themes, particular types of stocks, growth stocks in particular. Value sectors at times have started to improve, but not really overtaking. Small caps are still kind of just back in the back seat waiting to emerge. I mean, how do you think about leadership rotation, and do you see signs of rotation? Is it a macro story with rates and the Fed, or how do you think about it?
So, as I think about the last few years, we saw the Mag 7, really, that was where the valuations were incredibly high. That was the rally was in that very concentrated group of names. Yeah. But in many respects, that made sense because that was where the earnings growth was coming from.
Sure.
And so, I forced myself to go back and dust off my playbook from the mid to late 90s when PEG ratios were important.
All right, yeah.
And because it helped make sense of how the market was behaving, and I think it's a valid way to approach high valuations because they really were delivering when very few other stocks were. Now we've come to a place where that earnings participation, shall I say, is broadening. Yeah. We've gotten more and more contributors to earnings growth. Yep. And so I would imagine, I shouldn't say imagine, I expect this rotation to continue, to broaden. And there should be greater participation. Now that doesn't mean that tech names fall off. But I do think this is a time where we've gone from like a micro focus on hyperscalers to now broadening out. I mean, we've seen sort of the utilities and how they're viewed as beneficiaries.
Yep.
I think now, especially with the DeepSeek news, we're now entering a new phase where it's going to be about the companies that are benefiting from AI, that are using it and benefiting, and that is all different industries and sectors.
It's a lot of different companies,
and it's a lot of small caps. I think those, we're not there yet necessarily in terms of market perception, but we'll get to the point where markets realize how much small caps are benefiting from the use of AI. So
I like that.
I think that's my look ahead as to where things go.
That's super helpful, Kristina. So we're here at the Money Show. One final question. A lot of individual investors, I feel like institutional investors seem to have a very good sense of risk and risk management and what that means for their portfolios. I found individual investors maybe less comfortable with what risk means in balancing potential returns versus potential risk. How should attendees at the conference here be thinking about risk management? How should that inform their decision making about allocations and diversification?
Well, I'm a big believer, having sat on a nonprofit endowment many years ago, I'm a big believer in individual investors having investment policy statements. That is the way to create structure, right? And especially if you don't have an advisor, creating those guardrails, deciding in an emotional vacuum what your allocations are going to be, and essentially the rules of the road, how well diversified you want to be, can be incredibly valuable for individual investors.
That's so well put, Kristina. I know in my Fidelity days, having a new portfolio manager having to lay out on one page, here's my edge, here's how I'm going to try to do it. Just the practice of having to put that on paper, all of a sudden, any sort of issues kind of came out very, very quickly, and we could sort of address those. So I hope individual investors take your advice there. This has been such a pleasure, Kristina. Thanks so much for answering my questions. Enjoy the rest of the show. Have a safe trip back to the East Coast, all right?
Thank you so much.
Thank you. It was a pleasure. What a great discussion with Kristina Hooper, Chief Global Market Strategist of Invesco. I thought her comments, their answer to the last question about how individuals should think about risk management, I thought was really well put. Great ideas there, and I hope that encourages you to think about, balancing your, as an individual investor, balancing your efforts to capture potential returns with the importance of recognizing the risks, right? And I found a lot of times, and as we discussed, a lot of investors in 2024 pretty comfortable taking on a lot of risk, pretty comfortable probably having a more concentrated portfolio than we may want. And now all of a sudden in early 2025, we're starting to see the risks of that sort of mentality. So I thought her comments there were really well put. Really appreciate being able to ask someone like Kristina, ideas about the Fed and just, thinking about the Fed rate cut cycle, the pause in rate cuts, potential rate hikes, what all those things mean relative to the inflation and consumer data and jobs data that we've been observing even since our conversation just a couple weeks ago. Thanks so much, all of you, for following my work here on the Market Misbehavior podcast, on our market recap show, Chart This with Dave Keller. And if you want to improve your own ability to cut through the noise, to focus on the signal using the best practices of behavioral finance and technical analysis, our Market Misbehavior Premium members may be a really good idea, particularly as we're in this rotational environment when a lot of charts are changing rapidly, a lot of news flow causing the charts to evolve. What better time to focus on the evidence the markets provide back to us in the form of price action? 3 great benefits to the Market Misbehavior Premium membership. Virtual courses, which we're actually actively improving on and adding to as we speak. This week, we're actually working on a new course on technical indicators we'll be releasing very soon to our Market Misbehavior Premium members. You can access all of those on demand at your own pace. Second thing, a series of premium members only reports like our weekly flight plan and our monthly chart review, both of which we just produced most recently in the last week. Finally, you'll have access to our members-only community where you can ask questions, you can see what questions other active investors are running into, and I'm in there every day supporting our members, answering questions, and encouraging you to improve your own market awareness. You can find more information about our premium memberships at marketmisbehavior.com/premium. Don't forget to use the code PODCAST when you check out for 30% off your first 12 months on any plan. That's it for today. Thanks so much for listening to today's podcast. Enjoy your support and enjoy and appreciate all of your thoughtful comments over the years. Keep them coming, and we'll look forward to providing more great conversations with you in the days and weeks and months to come. For Market Misbehavior, I'm Dave Keller, and remember, it's always a good time to own good charts.